we've reduced our vacancies from 4.5% to 3.1%, and we can say post the reporting period, we've reduced that further to 3%. We've reduced our arrears from 4.4% to 3.1%. We've reduced our loan to value from 36.2% to 32.2%. Reduced our vacancies from 4.5% to 3.1%. And we can say post the reporting period, we've reduced that further to 3%. We've reduced our arrears from 4.4% to 3.1%. We've reduced our loan to value from 36.2% to 32.2%. And our interest cover ratio increased from 2.9 times to 3.3 times. And most importantly, we will be paying an interim distribution of 10.590 cents per share. Having a look at COVID, this pandemic has created chaos in our market. Our management team has worked hard to keep our properties fully let, and we can now confirm that the majority of rent relief negotiations with our tenants have been concluded. Well, there's been an additional 9.7 million rands worth of concessions made over the last 6 months. However, during this period, we've managed to reduce our arrears, as I said previously, by 26.7% to 16.7 million rand. And very, very importantly, our collection of deferrals has been much better than anticipated. Most importantly, we can also confirm that all interest on debt has been funded out of operations. So we have a well-developed strategy, which has proven to be more resilient than other strategies out in the marketplace, and we will continue to differentiate ourselves rather by performance than by size. Fairvest will maintain its focus on acquiring grocery-anchored and essential service retail assets, weighted predominantly to non-metropolitan, rural areas, as well as convenience and community shopping centres that service the lower LSM market, obviously located in high growth nodes and close to consumer transport and networks. Again, we have to reiterate, managing assets in a bear market is completely different to managing assets in a bull market. And we recommend that when investors do look to invest in the REIT sector, they must do a thorough due diligence on the management teams and ensure that your management teams are experienced in both a bull and a bear market. Fairvest is fortunate enough to have a team of hands-on property professionals who have deep experience in both bull and bear markets. Let's have a quick look at this slide. In terms of total returns over the 1, 3, and 5 and 10-year period, Fairvest has featured in the top 3 amongst the JSE's universe of 28 SA-based REITs. And as you can see, we've outperformed the indexes, and this really talks to our track record. So in difficult conditions, we've still managed to improve the quality of our assets, increasing the average asset per value to just under 80 million rand an asset. There's been a small increase in asset value per square meter to 13,360 rand a square meter. Our net asset value increased to 2.25 billion, and our market cap was at 1.8 billion. So, I've said this to you, I think, for the last 10 years. Property is simple. There are 2 key focus areas: leasing of vacant space and collecting of rentals. We do both, and we do both well. So as you can see from this slide, we've reduced our vacancy factor from 4.5% to 3.8%. And most importantly, We've reduced our collection rate, increased our collection rate and reduced our arrears from 4.4% to 3.1%. And we are expecting this to reduce further over the period. Another interesting slide. This talks to the core of our property business. You can see our like-for-like annualized growth in net property income has increased since June from 0.8% to 6.3%, and this can be attributed to items such as savings on solar expenses, a weighted average contractual lease escalation of 7.1%, improved leasing over the period, and obviously less CD19 rental credits. So, our business is strong and on the front foot because of how we have behaved as a team, not just in the past year, but because of how we've behaved as a team over the last 10 years. We have a robust balance sheet. We have interest cover ratio of 3.3 times. Our NAV is 2.29 cents per share. There is no change in our distribution payout ratios. We've reduced our vacancies from 4.5% to 3.3%. We have outperformed the indexes, and we have a management team with deep experience. And most importantly, we have a management team that can be trusted. So take a good look at this slide. It's abundantly clear that it's a good time to invest in Fairvest.
Fairvest declared an interim dividend of 10.59 cents per share for the 6 months to 31 December 2020. This is a 5.1% decrease from the distribution for the corresponding year, 31 December 2019. However, this period excludes the impact of COVID-19. If you therefore compare the distribution to our distribution for the 6 months to 30 June 2020, this was a 7.2% increase. Over the past 6 months, we continued to see the impact of the pandemic on our tenants. The majority of the negotiation with our tenants has been concluded for rental relief, especially during the hard lockdown period. Further rental credits were provided to the value of 9.7 million rand. Of that, 3.7 million were anticipated in the previous financial year, which we provided for. A large portion of these credits relates to tenants that previously elected to defer their rental for the lockdown periods, now electing to rather have outright credits for portion of their rental over that period. A dividend reinvestment alternative was offered to our shareholders who can elect to receive all or a portion of the dividend as new Fairvest shares. Please refer to the detailed SENS announcement also released this morning. The board also again resolved to declare 100% of distributable income as a dividend, and any changes in this policy will be communicated to shareholders at least 12 months in advance. If we look at a simplified income statement, the rental income and recoveries increased marginally by 0.7% compared to the previous year, with new acquisitions in the prior year offset by the disposal of Tokai and additional rental concessions provided during the current period. Property expenses decreased by 1.8% as a result of various cost containment efforts and also due to the solar initiatives reducing our electricity expense. This resulted in savings of 5 million rand during the period. As Darren mentioned previously, on a like-for-like basis, the net property income increased by 6.3%, with the solar savings being a large contributor and also significant rental concessions provided during the comparable period. Net structured funding income continues to be earned on the funding provided to our equity and development partners, and as communicated previously, this continues to decrease in line with our strategy. Corporate and administrative expenses increased by 4.1%. Therefore, distributable earnings for the period decreased by 6.6% to 103.8 million. However, additional treasury shares were acquired in the second half of the previous financial year. Therefore, on a per share basis, the decrease is 5.1% to 10.59 cents per share. On the balance sheet, the non-current assets increased mainly as a result of an increase of the property portfolio with some additional solar investments during the period and a marginal increase in the asset valuations. This will be discussed further in the next slide when we talk about the valuation methodology. Tokai Junction was disposed of during the period and transferred on 1 October 2020. The increase in current assets is as a result of loans receivable being due over the next 12 months, and also the increase in current liabilities are due to long-term loans up for refinance over the next year. This will also be discussed further when we talk about the debt. The net asset value per share is 229.32 cents per share, and with yesterday's closing share price of R1.80, this is a 21.5% discount.